Our next topic is risk and uncertainty. Risk means what? Risk is something which is foreseeable. Uncertainty is something which is not foreseeable. Risk is something which is manageable or can be reduced. Uncertainty is something which is not manageable because it is unforeseeable or can't be reduced. We can use different risk management techniques to reduce risk. Here we can use insurance contract to avoid the loss of uncertainty. Uncertainty means what? It means accident, it means fire, it means earthquake. These are the uncertain events which can arise anytime, and this loss can be managed with the help of insurance contract. Now we have different concepts which deals with risk and uncertainty. First one is IRR. We have already discussed this IRR. It measures what? It measures sensitivity of discount rate. For example, your discount rate is 11%, your IRR is 16.5%. So how to calculate the sensitivity of discount rate is equal to IRR minus discount rate divided by discount rate into 100. It is 50%. So it shows what? It shows that your IRR is 50% greater than your cost of capital. So if it is 50% greater, it means it is significantly high. So we can say that this investment is not highly risky. This is not a very risky investment. Second concept of sensitivity analysis deals with the revenue and cost. For example, question says you to calculate the sensitivity of selling price. Now, how will you solve this? Suppose you have 4-year project and you have sales revenue of 500,000 in year 1, 630,000 in year 2, 690,000 in year 3, 800,000 in year 4. We will deduct tax if provided in the question. Suppose tax rate is 20% and payable at the end of each year, which means tax for the year 1 is payable at the end of year 1. So how to deal with this? 20% of this amount, which is called 100,000, 20% of this amount. Then we have 690,000 into 0.2. It is 138,000. It is 160,000. So here we have after tax cash flows. $400,000, $504,000, it is 552,000, and it is 640,000. 640,000. Now we will calculate present value. Suppose present value factor is 10%. For year 1, we have 0.909, 0.826, 0.751, 0.683. So it is 0.751, 414,552. Then 504,000 into 0.826, 416,304. First one is 363, 600. These are the present values. So now we will calculate present value of cash flows is equal to sum of all these values it is 1,631,576. These are the present value of cash flows. Now how to calculate sensitivity of this? This is present value of cash flows, or we can alternatively call it present value of revenue after tax, because here we are calculating only sensitivity of the selling price. So sensitivity percentage is equal to net present value. Suppose net present value is like $250,000 divided by present value of relevant item after tax. Here relevant item is revenue into 100 to convert into percentage. So the answer is 15.32%. What does it mean? If selling price will fall by 15.32%, then NPV will be 0. This is the sensitivity of the selling price. Suppose if you are required to calculate sensitivity of the variable cost. Any question before moving variable cost? Okay. So how to deal with the variable cost? Pattern is same, but definitely variable cost is the cost. So that's why there will be no payment of taxation. There will be saving of taxation. Sensitivity of variable cost. Suppose here we have year 1, 2, 3, 4, 5. Variable cost is the cash outflow. That's why we will show this amount in the bracket. Suppose we assume that variable cost for year 1 is 150,000, for year 2 is 200,000, then 2,670,000, and then 350,000. Now less tax payment. Sorry, here we don't have tax payment, here we have tax saving. Tax saving because we are paying cost. Suppose it is 20%, and further he says that 1 year in arrears. 1 year in arrears means what? Now tax for the year 1 is not payable here. It is paid in year 2. Year 2 taxation is paid in year 3. Year 3 taxation is paid in year 4. Year 4 taxation is paid in year 5. Now calculate after tax cash flows. For year 1 it is 150,000. For it is tax saving. So there will be no use of brackets over here. Brackets are used for the payments. Here we have 170,000. Then we have 230,000. Then we have 296,000. And then we have cash inflow of 70,000 because it is a payment. So it is a saving. Rests are in negative. Now present value suppose at 10%, 0.909 in the from the present value table, 0.826, 0.751, 0.683, 0.621. Next is to calculate present values. That is 136, 350. Next one is 170,000 to 0.826. Then 230,000 to 0.751. Now calculate NPV of variable cost after tax. We will add all these values except the year 5. It is in cash flow. So we have negative 608,198. This time it is a cost, so that's why it is negative. Now calculate sensitivity percentage. Suppose NPV is $75,000 divided by present value of relevant cash flow, which is after tax, 608,198 into 100. So 12.33%. Here we will say if variable cost will rise by 12.33%, then NPV will be 0. On the other hand, for the sale price, we were saying fall by, because sale is income. If income will fall down, we will be in loss. If income cost will rise, we will be in loss. Right? Any question? This is the way to calculate sensitivity of the variable cost. Suppose you are required to calculate minimum number of units per year to sell, which means break-even point. Now how to calculate? For this you will use fixed cost per year plus equivalent annual cost of initial investment divided by contribution per unit. Fixed cost per year and contribution per unit is simple, but how to calculate the equivalent annual cost of initial investment? We have already learned this equivalent annual cost in asset replacement cycle. Here it means, suppose you are making initial investment of 750,000 for 5 years. 5 years is the initial time period and 10% is your discount rate. So to calculate equivalent annual cost, we always divide relevant cash flow with the annuity factor at given cost of capital for given years. So it is divided by what? 3.791. So 750,000 divided by fifth year annuity factor at 10%, which is 3.791. 750,000. So it is 197,837. Now we will follow this formula. Suppose fixed cost is per year is $400,000 plus equivalent annual cost is 197,837. Suppose contribution per unit is 15. So it is 39,856 units. 39,856 units per year are necessary to sell to achieve this break-even point. If we will sell 39,856,000 units each year, we will be able to achieve zero net present value. Any question? Okay. Now we will discuss another important concept